Rebounding as central banks around the world print more money. Yeah, people fleeing into these safer trades. Right now you're talking about gold up another $10 today, $965 an ounce. We've been following this trend and much more, and so has Jim Grant. He's the editor of Grant's Interest Rate Observer. And Jim, it's great to have you here today.
Thank you, Becky. Nice to be here.
Let's talk a little bit about those gold prices. Is there a concern, should there be more concern about inflationary pressures out there based on all the printing of money that we've seen?
Well, central banks are doing what they have literally never done before. There's a very pretty phrase for this policy, which is quantitative easing, which almost sounds as if it were the creation of some Nobel laureate. Quantitative easing is money printing on the wholesale level. And not just the Federal Reserve, but the Bank of England is at it. The Swiss National Bank, of all banks, is at it, or at least professes to be, not to mention the Reserve Bank of Zimbabwe, which actually led the way. But the Fed, for example, to give you an idea of what is going on in the Fed, for decades and decades, the Fed's balance sheet showed $20 billion of deposits by commercial banks. That's it. $20 billion. It was like $20 billion in the Eisenhower administration, $20 billion in 2007, and now it is $830-odd billion. From 20 billion over like 4 or 5 decades to 830-something billion in one fell swoop, or one fell leap. And people say, well, so what? This is tinder, but it is soaking wet tinder because of the skies opening and because of the debt crisis. But no one does know when the sun shines again. And this wet tinder can become very well dry, in which case we might see a whole lot of unscripted inflation.
You think we're headed down the road that Zimbabwe's already taken?
Please say no.
That was a rhetorical flourish,
yeah,
Becky.
Okay.
But certainly the theory of money printing is not so far away from Gideon Gono, who is, by the way, the governor of the Reserve Bank of Zimbabwe. So he and Ben Bernanke have not so much in common except a faith in the capacity of central banks through money creation.
He's a piece of work, that guy.
What, Gideon Gono?
Yeah, cracks me up.
So, Jim, would you support the bill that is in front of the House at the moment? It has 206...
Whatever the bill is, no, I'm against it.
No, but listen to that, because that supports what you're saying. It has 206 co-sponsors, and it's in favor of auditing the Fed.
Auditing, yes.
You're in favor of that?
Yes, sunshine is good. And the Fed actually is audited, but it might be better audited. The Fed is this peculiar institution. It is a bank, but a most unusual bank. And if the Fed examiners were set upon the Fed's own documents, unlabeled documents, to pass judgment on the Fed's capacity to survive the difficulties it faces in credit, it would shut this institution down. The Fed has like $45 billion of capital, $2.1 trillion of assets, including the dogs and the cats of the credit difficulties. And the Fed is undercapitalized in the way that Citicorp is undercapitalized, at least before the magical transference of preferred to common. That is over, right? We saw that?
Yeah, we did.
Okay.
It's beautiful. I mean, the bank looks so much better.
You are actually speaking about the dangers of misplaced hope, as you called it, in terms of protracting recession.
Well, yeah, dangers of misplaced hope and, of course, mispriced assets. We are making progress in this slump. Every day seems a little bit better than the preceding day, which is good. But I guess we have to, there are natural curative processes in markets, right? Low prices are the cure for low prices. At low prices, people produce less and they buy more. Ergo, we're still not in the recession of 1991. We're still not in the Great Depression. So cycles are, to a degree, self-curing. And I think that the self-curing is perhaps is of greater benefit this time around than the exertions of our government.
Jim, we've been kicking around the theoretical way that inflation is created through printing money,
yeah,
and then the actual way that it happens, and that is where employment gets tight, pricing power comes back, things get the economy. We're not there, and it's hard to see how it seems like you got to connect a lot of dots to get the printing of the money to inflation in this period. How long does it take?
Well,
take 5 years?
Well, the last great hope of the Treasury bond bulls is so-called output gap, and they observe that we can produce so much, and we are producing so little. And the gap between what we could produce and what we are producing measures the slack in the economy. And so great is this slack, they say, that it will be fiscal quarters years before there's anything like a murmur from the inflation front.
Can we soak up? Can the Fed soak up the liquidity so we could?
Oh, can the Fed soak it up? It could.
I mean, can we somehow avert this disaster that we're talking about?
No, with the prospective inflation.
Yeah.
Yes, but let me speak to this output gap first. That is not an especially good leading indicator of inflation. It hasn't been. Paul Casriel of Northern Trust has shown that it's not very reliable.
Plus tell us what's happening right now. Right. Inflation is based on what people think is going to happen.
But you have unemployment still rising, too.
Inflation also is based principally upon the rate of money printing. And M2 was growing 9% year over year, which is very different, by the way, than the Depression of 1929 and 33. What you didn't have then was M2 growing at 9%.
But when you have unemployment getting up towards 10%, can you get that sort of price spiral that comes in?
To me, inflation is too much money. It's not too much money chasing too few goods. It's too much money. What the money chases is variable cycle to cycle. It can chase skirts or toothpaste prices or oil. It can chase financial asset prices. It can chase metals prices. So it seems to me that too much money is what we have. Just on inspection, and what that money is going to chase, it remains to be seen. I think that we will see higher conventional CPI inflation sooner than you expect, based upon the apparently dawning odds against it that the output gap suggests. I think that the output gap is going to be a red herring.
Does the Fed need to raise rates?
If I were running the Fed, yes. I think 0 is the wrong rate for almost any economy. And the Fed, I think, is embarked with a zero interest rate project. It's embarked on a vast experiment in moral hazard. The trouble with suppressed interest rates, with zero interest rates, is that they're like interest rates are the traffic signals in a market economy. And everything's green. And the junk bond market is up 30% year to date. The leverage loan market is up massively. All this credit stuff is coming roaring back, which is good because it indicates a healing of our financial system. But you have to wonder whether these interest rates are the right clearing rates or whether they are rather the imposition of the central bank. So I think that the rates are kind of too low.
So if we imagine for a minute that you were running the Fed, in fact, I really like that idea of you running the Fed.
Actually, I'm kind of busy around.
But I don't know if we could convince you by the end of the show. But what would you do with the bank's toxic assets?
It seems to me, to quote an anonymous bond trader, there are no bad bonds, only bad prices. And toxic assets are a defined term. To me, we ran a piece in Grants last fall, and the headline was Toxic Treasuries, Super Safe Mortgages. And our line, which we still hew to, is that Treasuries were mispriced horrifically at 2% or so in the 10-year. That was a toxic asset, whereas mortgages at 50 cents on the dollar in some of these residential mortgage-backed security structures were actually quite promising because they were value-laden, because they were cheap at the price given the risk. So I still think that Treasuries are mispriced. So that's to me is a toxic. To be sure, there is residual toxicity in all of these screwy structures that Wall Street invented. But there is general mispricing and, of course, a very huge asset class, namely government securities worldwide.
So you could have really bad inflation, devastating inflation that hurts financial assets and hurts everything without a wage price spiral. If there was just so much money chasing
skirts.
Chasing skirts or whatever. You don't need,
I heard that.
See, that makes me reevaluate the whole wage price spiral. Was that just specific to the 70s and what happened, or it doesn't have to happen that way? Did it happen in Germany when they had the wheelbarrows full of cash? Was it a wage price spiral? Or
no, that was a central bank. And, it was
we can do it without
the currency collapse. There are plenty of instances of very weak economies generating very high inflation.
Yeah.
Look in South America.
Great, we've been hoping for that.
I know, that was my last hope.
Someone we know did a Google search for the words inflation and deflation. And deflation turned up 4.6 million results. Inflation gave 10 times that. Do you think the worry really is about inflation and not the opposite?
Oh, when did this person do the search?
I think today.
Today, yeah. I think you would have gotten a different result a few months ago. Speaking of contrary opinion, there's something that ought to be concerning. Namely, Bloomberg, I think, reported that 15 out of 16 primary government bond dealers are in agreement that the Fed will not move before the year is out. And the federal funds futures market, of course, is indicating that a tightening is coming rather sooner than later. And if your hairs in the back of your neck stand up when there's too much when there's unanimity of opinion, then one begins to worry about this. The Fed has proverbially been late, and literally, it was like 2 years raising rates after the recession of 1991-92. It was like 2 years or so raising rates after the tech bust of the early aughts, and neither one of those occasions was the financial system apparently dying of a fatal heart attack.
But that was under the incrementalist Greenspan, right?
Right. Well, Bernanke has shown certainly a willingness to print money and a reluctance to tighten. But everyone expects that.
I quoted you at the beginning of the show.